Introduction. Investing in hedge funds and private equity has become increasingly popular in recent years as more and more individuals seek out alternative investment opportunities. However, for those who are new to the world of alternative investments, it can be difficult to know where to start. This audiobook is designed to provide a comprehensive introduction to hedge funds and private equity investing and offer practical investment advice for individuals looking to enter this exciting and potential lucrative space. Whether you are a seasoned investor or just starting out, this audiobook will provide the essential information and guidance you need to make informed investment decisions in the world of hedge fund and private equity. So let's get started on your journey to becoming a more well rounded and sophisticated investor. Chapter 1. Introduction to Alternative Investments. Investing in traditional assets such as stocks, bonds, and real estate can provide a solid foundation for a diversified portfolio. However, many investors are seeking out new and innovative ways to grow their wealth and hedge against market volatility. Alternative investments such as hedge funds and private equity have become increasingly popular as a result. Alternative investments, also known as non traditional investments, are investment vehicles that operate differently from conventional investments and are designed to offer potentially higher returns and diversification benefits. These investments include, but are not limited to, hedge funds, private equity, real estate, commodities, and commodities based investments. One of the key benefits of alternative investment is the ability to access new and potentially profitable investment opportunity that are not available through traditional investment channels. For example, hedge funds often employ complex investment strategies and use leverage to maximize returns, while private equity funds focus on acquiring and growing private companies. Despite their potential benefits, alternative investments also come with unique risks and challenges. It's important to thoroughly understand the characteristics of these investments and the potential risks involved before making any investment decisions. In conclusion, alternative investment can play an important role in a diversified investment portfolio. However, they require careful consideration and a thorough understanding of the unique risks and benefits associated with each type of alternative investment. This audiobook will provide the information and guidance you need to make informed decisions about alternative investments and pursue your investment goals with confidence. Chapter 2. Hedge funds, an overview. Hedge funds are one of the most well known and popular alternative investment options. Hedge funds are private investment vehicles that use a variety of investment strategies and tools, including leverage, short selling, and derivatives, to generate returns that are not correlated to the traditional stock and bond markets. The term hedge fund refers to the fact that these funds are designed to hedge or reduce the risk associated with investing in traditional assets. However, this does not mean that hedge funds are risk free. In fact, some hedge funds employ high risk strategies that can result in substantial losses. Hedge funds are typically managed by experienced investment professionals who employ a variety of strategies to generate returns. These strategies can range from basic long short equity strategies to complex multi strategy portfolios. One of the key benefits of investing in hedge funds is the ability to access a wider range of investment opportunities and strategies than are available through traditional investments. For example, hedge funds may invest in a variety of assets, including stocks, bonds, commodities, currencies, and real estate. Another key advantage of hedge fund is their flexibility. Unlike traditional investments, hedge funds have the ability to invest in a variety of assets and employ a wide range of investment strategies. This allows hedge fund to adapt to changing market conditions and generate returns in both bull and bear markets. Despite their benefits, hedge funds also come with unique risks and challenges. One of the main challenges is the lack of transparency. Unlike traditional investments, hedge funds are not required to disclose their holdings or investment strategies to the public. This makes it more difficult for investors to assess the risk associated with these investments. In conclusion, hedge funds can offer a unique opportunity to access a wider range of investment opportunities and strategies. However, these investments are not suitable for all investors, and it is important to thoroughly understand the risks involved before making any investment decisions. In the following chapters, we will explore the various types of hedge fund strategies, the pros and cons of investing in hedge funds, and the steps you can take to evaluate and manage the risk associated with these investments. Chapter 3: Types of Hedge Fund Strategies. Hedge funds employ a variety of investment strategies in order to generate returns that are not correlated with the traditional stocks and bond markets. Some of the most common hedge fund strategies include: 1. Long short equity. This is the most basic hedge fund strategy and involves taking both long and short positions in individual stocks. Long positions are taken in stocks that the fund believes will increase in values, while short positions are taken in stocks that the fund believes will decrease in value. 2. Event driven. This strategy focuses on investing in companies undergoing major events such as mergers, acquisitions, or bankruptcies. The goal of these strategies is to generate return by taking advantage of market inefficiencies and mispricing that results from these events. 3. Macro. This strategy involves making investment decisions based on macroeconomic trends and events. Macro hedge fund managers attempt to generate returns by taking positions in a variety of assets, including stocks, bonds, currencies, and commodities. 4. Fixed income arbitrage. This strategy involves taking advantage of inefficiencies in the fixed income markets. For example, a hedge fund manager might purchase a bond and simultaneously sell a similar but not identical bond in order to take advantage of a pricing discrepancy. 5. Distress debt. This strategy involves investing in the debt of companies that are in financial distress. The goal is to generate returns by restructuring the debt and ultimately receiving a higher return on investment. 6. Multi strategy. This strategy involves using multiple hedge fund strategies within a single portfolio. The goal of this approach is to diversify the portfolio and generate returns that are not correlated with the stock and bond markets. It is important to note that each of these strategies come with its own unique risks and rewards. It's also important to understand that the performance of a hedge fund is not solely dependent on its investment strategy, but also on the skill and experience of the fund manager. In conclusion, hedge funds employ a variety of investment strategies in order to generate returns that are not correlated with the traditional stocks and bond markets. Understanding the different types of hedge fund strategies is an important step in evaluating and managing the risk associated with these investments. In the following chapters, we will explore the pros and cons of each of these strategies and provide guidance on how to evaluate and choose a hedge fund that is right for you. Chapter 4. The role of hedge funds in investment portfolios. Hedge funds are alternative investment vehicles that employ a wide range of strategies to achieve high returns while minimizing risk. They are known for their ability to generate strong returns in both bullish and bearish market conditions, making them an attractive addition to investment portfolios. In this chapter, we will examine the role of hedge funds in investment portfolios and how they can help investors achieve their financial goals. Hedge funds employ a variety of investment strategies, including long short equity, event driven, and macro strategies. This allows them to hedge against market risks and generate returns regardless of market conditions. Additionally, hedge funds often have the ability to take advantage of market inefficiencies, which can lead to higher returns compared to traditional investments. One of the main benefits of hedge funds is their ability to provide diversification. Because hedge funds employ a wide range of investment strategies, they can reduce the overall risk in an investment portfolio. This can help investors manage their exposure to market risk and reduce the impact of market volatility on their portfolio. Hedge funds also offer investors the opportunity to access new and unique investment opportunities. Many hedge funds specialize in niche markets or employ strategies that are not available through traditional investments. This allows investors to diversify their portfolio and access new investment opportunities that may not be available through more conventional means. Despite the many benefits of hedge funds, there are also some risks associated with investing in these vehicles. Hedge funds are often subject to higher fees and charges compared to traditional investments, which can reduce the overall returns for investors. Additionally, hedge funds can be more volatile and less transparent than other investment options, making it important for investors to thoroughly research and understand the strategies employed by the hedge funds they are considering. In conclusion, hedge funds can play a valuable role in investment portfolios by providing diversification and access to new investment opportunities. However, it is important for investors to carefully consider the risks and fees associated with these vehicles before making a decision to invest. As with any investment, it is recommended that investors seek the advice of a financial professional and thoroughly research their options before making a decision. Chapter 5: The Pros and Cons of Investing in Hedge Funds. Hedge funds have been a popular investment option for decades, offering a range of benefits and potential drawbacks to investors. In this chapter, we will examine the pros and cons of investing in hedge funds to help investors make an informed decision. Pros of investing in hedge funds: 1. Diversification. Hedge funds often employ a range of investment strategies which can help to diversify an investment portfolio and reduce overall risks. 2. High returns. Hedge funds have the potential to generate high returns, particularly in challenging market conditions. 3. Access to unique investment opportunities. Many hedge funds specialize in niche markets or employ strategies that are not available through traditional investments, providing investors with access to new opportunities. 4. Expertise. Hedge fund managers often have years of experience and specialized knowledge, which they can use to generate strong returns for investors. Cons of investing in hedge funds: 1. High fees. Hedge funds are often subject to higher fees and charges compared to traditional investments, which can eat into returns for investors. 2. Volatility. Hedge funds can be more volatile than other investments options, making it important for investors to thoroughly research the strategies employed by the hedge funds they are considering. 3. Lack of transparency. Many hedge funds are not required to disclose their investments or strategies, making it difficult for investors to fully understand their investments. 4. Risk of loss. As with any investment, there is always the risk of loss when investing in hedge funds. It is important for investors to thoroughly research their options and understand the risks before making a decision. In conclusion, investing in hedge funds can be a valuable addition to an investment portfolio, offering the potential for high returns and diversification. However, it is important for investors to carefully consider the potential drawbacks, such as high fees and volatility, before making a decision. As with any investment, it is recommended that investors seek the advice of a financial professional and thoroughly research their options before making a decision. Chapter 5: Understanding Private Equity. An Introduction. Private equity refers to investments made in companies that are not publicly traded on stock exchanges. This type of investment is typically made by private equity firms on high net worth individuals and can provide significant returns for investors. In this chapter, we will provide an introduction to private equity and the benefits and risks associated with this type of investment. Private equity firms typically invest in companies that are not publicly traded with the aim of growing the company and increasing its value. They may invest in a company at any stage of its development, from startup to established business, and may use a variety of strategies, including buyouts, growth capital, and turnarounds. One of the main benefits of private equity investment is the potential for high returns because private equity firms invest in companies with growth potential, they can often generate strong returns for investors. Additionally, private equity firms often bring expertise and resources to the companies they invest in, which can help to further increase the value of the investments. However, there are also risks associated with private equity investments. Private equity investments are typically less liquid than publicly traded stocks and bonds, meaning that investors may have difficulty selling their investment in a timely manner. Additionally, private equity investment are often subject to higher fees and charges compared to traditional investments, which can eat into returns for investors. In conclusion, private equity can provide investors with the potential for high returns and access to unique investment opportunities. However, it is important for private investors to thoroughly understand the risks and fees associated with these investments before making a decision. As with any investment, it is recommended that investors seek the advice of a financial professional and thoroughly research their options before making a decision. Chapter 7: Types of Private Equity Funds. Private equity funds provide investors with the opportunity to invest in companies that are not publicly traded. These investment vehicles pool money from multiple investors to make investments in private companies with the aim of growing the company and increasing its value. There are several different types of private equity funds, each with its own unique investment strategy and goals. In this chapter, we will examine some of the most common type of private equity funds and the characteristics that define each type. The first type of private equity fund is buyout funds. Buyout funds focus on acquiring companies that are not publicly traded and are known for their use of leveraged buyouts, management buyouts, and growth capital investments. The goal of these funds is to grow the company and increase its value, with the aim of eventually selling the company for a profit. Buyout funds typically invest in mature companies with a proven track record of success, and they often have a hands-on approach to the companies they invest in. Another type of private equity fund is venture capital funds. These funds invest in early stage companies with high growth potential and provide startups with the capital and resources they need to grow. Venture capital funds often play a hands-on role in helping these companies to succeed, offering expertise and guidance in areas such as product development, marketing, and fundraising. While the potential for high returns is a major attraction of venture capital funds, the high risk associated with early stage companies is also a major consideration. Growth capital funds invest in established companies that are looking to expand and grow. These funds provide companies with the capital they need to expand into new markets, acquire other companies, or invest in research and development. Growth capital funds are generally less risky than venture capital funds, as they invest in companies with a proven track record of success. However, they also tend to have lower potential returns compared to other types of private equity funds. Distress funds, as the name suggests, invest in companies that are facing financial difficulties, such as bankruptcy or restructuring. The goal of this fund is to turn around the company and generate a profit for investors. This type of private equity fund requires a high degree of expertise, as distressed companies often face complex financial and operational challenges. However, the potential for high returns can make distressed funds an attractive option for experienced investors. Finally, mezzanine funds provide companies with a mix of debt and equity financing, filling the gap between traditional debt and equity financing. This type of private equity fund may be used to finance acquisitions, expansion, or recapitalizations and provide companies with an alternative source of financing that is typically more flexible than traditional debt. Mezzanine funds can be a suitable option for companies that do not qualify for traditional financing but are not ready to go public. Chapter 8: The Private Equity Investment Process. The private equity investment process is a multi step process that involves a range of activities, from sourcing and evaluating potential investment opportunities to making the investment and monitoring its performance. This chapter will provide an overview of the key steps in the private equity investment process and outline the key considerations for investors. The first step in the private equity investment process is sourcing investment opportunities. This involves identifying companies that fit the investment criteria of the private equity fund, such as companies that are looking for capital to grow their business or companies that are facing financial difficulties. Private equity funds may source investment opportunities through a variety of channels, including industry networks, financial advisors, and other sources of deals flow. Once investment opportunities have been identified, the next step is to perform due diligence. This is a comprehensive evaluation of the company's financial and operational performance, as well as its market position and future growth prospects. The goal of due diligence is to determine the potential risks and returns of the investment and to make a final decision on whether to invest in the company. If the investment opportunities passes due diligence, the next step is to negotiate the terms of the investment. This may involve negotiating the purchase price, the structure of the investment, and the rights and obligations of the investors. Once the terms have been agreed upon, the next step is to close the investment and provide the company with the capital it needs to grow and succeed. Once the investment has been made, the private equity fund begins the process of monitoring its performance. This may involve regular meetings with the management of the company, analysis of financial and operational performance, and regular communication with investors. The goal of monitoring the investment is to ensure that the investment is performing as expected and to make any necessary adjustments to ensure that the investment continues to meet the investment criteria of the private equity fund. In conclusion, the private equity investment process is a multi step process that involves sourcing investment opportunities, performing due diligence, negotiating terms, closing the investment, and monitoring performance. The process can be complex, but it provides investor with the opportunity to invest in companies that are not publicly traded and to benefit from the potential for high returns and the benefits of an hands-on investment approach. As with any investment, it is important for the investors to thoroughly understand the private equity investment process and to seek the advice of a financial professional before making a decision. Chapter 9: The Pros and Cons of Investing in Private Equity. Investing in private equity can offer investor significant potential for high returns, but it also involves unique risks and considerations. This chapter will provide an overview of the key pros and cons of investing in private equity and help investors make informed decisions about whether private equity is right for them. One of the key pros of investing in private equity is the potential for high returns. Private equity funds invest in companies that are not publicly traded, which can offer the opportunity for higher returns compared to publicly traded companies. Additionally, private equity funds often take a hands on approach to investing, working closely with the management of the company they invest in to help them grow and succeed. Another benefit of private equity investment is the potential for increased diversification. Private equity investments can provide investors with exposure to a range of industries and businesses that they may not have access to through traditional investments. This can help to reduce the overall risk of an investment portfolio and provide a more balanced investment strategy. However, there are also significant risks associated with private equity investment. One of the biggest risks is the lack of liquidity. Unlike publicly traded companies, private equity investments are not easily tradable and may be illiquid for long periods of time. This can make it difficult for investors to access their funds when they need them and can result in significant losses if the investment does not perform as expected. Another risk associated with private equity investment is the potential for high fees. Private equity funds typically charge high fees to investors, which can reduce the overall returns of the investment. Additionally, private equity funds often require a significant minimum investment, which may not be accessible to all investors. In conclusion, investing in private equity can offer significant potential for high returns, but it also involves unique risks and considerations. The benefit of private equity investment include the potential for high returns and increased diversification, but the risks include lack of liquidity and high fees. As with any investment, it is important for investors to thoroughly understand the pros and cons of private equity investment and to seek the advice of a financial professional before making a decision. Chapter 10: Due Diligence and Risk Management in Alternative Investment. Due diligence and risk management are crucial components of investing in alternative investments, such as hedge funds and private equity. This chapter will provide an overview of the key consideration for due diligence and risk management in alternative investments and help investors make informed decisions about these types of investments. Due diligence is a process of evaluating the potential risks and returns of an investment. In the context of alternative investments, due diligence involves a comprehensive evaluation of the investment manager, the investment strategy, and the risks associated with the investment. This includes a review of the investment manager's track record, investment style, and risk management practices, as well as an analysis of the investment strategy and the potential risk associated with the investment. In order to perform effective due diligence in alternative investment, it is important to understand the unique characteristics of these types of investments. For example, Hedge funds may employ leverage and other complex financial instruments which can increase the risk of the investment. Similarly, private equity funds often take a hands on approach to investing, which can increase the risk of the investment but also offers the potential for higher returns. Once due diligence has been performed, the next step is to develop a risk management plan. This involves identifying and assessing the potential risks of the investment and implementing strategies to mitigate those risks. For example, investors may diversify their portfolio by investing in a range of different alternative investments or by investing in a mix of alternative investments and more traditional investments. In order to effectively manage risk in alternative investments, it is important to have a clear understanding of the investment strategy, the underlying assets, and the potential risks associated with the investment. This may involve ongoing monitoring of the investment and regular communication with the investment manager. In conclusion, due diligence and risk management are crucial components of investing in alternative investments such as hedge funds and private equity. Effective due diligence involves a comprehensive evaluation of the investment manager, investment strategy, and risks associated with the investment, while effective risk management involves identifying and mitigating the potential risks of the investment. As with any investment, it is important for investors to thoroughly understand the due diligence and risk management process and to seek the advice of a financial professional before making a decision. Chapter 11: Evaluating Hedge Fund and Private Equity Performance. Evaluating the performance of hedge funds and private equity investments is a critical component of the investment process. This chapter will provide an overview of the key considerations for evaluating the performance of these types of investments and help investors make informed decisions about their investments. The first step in evaluating hedge fund and private equity performance is to understand the benchmark that the investment is being compared against. For example, hedge fund may be benchmarked against a particular index such as the S&P 500, while private equity funds may be benchmarked against a comparable investment in the same industry. In addition to the benchmarking, it is important to consider the overall return of the investment as well as the risk adjusted return. Risk adjusted return takes into account the risk associated with the investment and provides a more accurate picture of the performance of the investment. Another important consideration when evaluating hedge fund and private equity performance is the investment manager's track record. This includes an analysis of the manager's investment style, performance history, and experience, as well as the size and stability of the firm. It is also important to consider the fees associated with the investment, as these can have a significant impact on the overall performance of the investment. Hedge funds and private equity funds typically charge high fees, which can reduce the overall return of the investment. In addition to the performance of the investment, it is also important to consider the alignment of the investment manager's interests with those of the investors. This includes an analysis of the investment manager's compensation structure an investment philosophy, and a determination of whether the investment manager is focused on maximizing returns for investors or on generating profits for the firm. In conclusion, evaluating the performance of hedge funds and private equity investment is a critical component of the investment process. Effective performance evaluation involves benchmarking the investment against relevant benchmarks, considering the overall return and risk adjusted return of the investment. Evaluating the investment manager's track record, considering the fees associated with the investment, and assessing the alignment of the investment manager's interests with those of the investors. As with any investment, it is important for investors to thoroughly understand the performance evaluation process and to seek the advice of a financial professional before making a decision. Chapter 12: The Future of Hedge Funds and Private Equity Investing. The hedge fund and private equity industries have grown rapidly over the past few decades, and they continue to evolve and change in response to market conditions and investors' preferences. This chapter will provide an overview of the future of hedge funds and private equity investing and help investors understand the potential opportunities and challenges that lies ahead. One of the key trends in the hedge fund and private equity industry is the increasing use of technology and automation. Automation is making it possible for hedge funds and private equity firms to analyze large amounts of data and make investment decisions more quickly and efficiently. Additionally, technology is also allowing for greater transparency and increased access to information, which can benefit investors by providing them with a clearer picture of the investment landscape. Another trend in hedge funds and private equity is the growing interest in environmental, social, and governance (ESG) investing. ESG investing refers to the integration of environmental, social, and governance factors into investment decisions. This trend is driven by a growing awareness of the impact of business practices on society and the environment, as well as a recognition of the potential of ESG investing to provide long-term financial benefits. The hedge fund and private equity industries are also facing increasing regulatory scrutiny. Governments around the world are implementing regulations to increase transparency, reduce risk, and protect investors. These regulations may impact the hedge fund and private equity industries by increasing the cost of doing business and potentially limiting the types of investments that can be made. Conclusion: Hedge funds and private equity investment have become increasingly popular over the past few decades as investors seek to diversify their portfolios and access alternative investment opportunities. Understanding the key features of these types of investments and the risks and rewards associated with them is critical to making informed investment decisions. In this audiobook, we have explored the fundamentals of hedge funds and private equity investing, including their historical background, investment strategies, and key consideration for investors. We have also examined the various types of hedge funds and private equity funds and the investment process for these types of investments. We have also discussed the importance of due diligence and risk management in alternative investments, as well as the methods for evaluating the performance of the hedge funds and private equity investments. Finally, we have looked ahead to the future of hedge funds and private equity investing and the trends and challenges that are shaping these industries. In conclusion, hedge funds and private equity investments can offer investors access to alternative investment opportunities and the potential for higher returns. However, these types of investments also come with significant risks, and investors should thoroughly understand the investment process and the potential risks and rewards before making a decision. With careful planning and a thorough understanding of the investment landscape, hedge funds and private equity investments can be an important component of a well diversified investment portfolio. This has been Hedge Funds and Private Equity, investing in alternative assets for maximum returns. Discover how hedge funds and private equity are reshaping the financial landscape. Written by Billy Gilmeister, read by Shafi. This is The Golden Age of Hedge Funds, a guide on how to succeed in hedge funds investing. Written by Will Oldenburg, read by Shafi. Introduction. Welcome to The Golden Age of Hedge Funds, a guide on how to succeed in hedge fund investing. In this audiobook, you will learn about the world of hedge fund investing, including the different strategies and techniques used by hedge funds and how to evaluate the potential risks and rewards of these investment vehicles. You will also discover how to create a diversified portfolio that includes hedge funds and other alternative investments, and how to properly manage your portfolio to achieve your financial goals. Whether you are a seasoned investor looking to add hedge funds to your portfolio or a beginner interested in learning more about this exciting and potentially lucrative form of investing, this audiobook will provide you with the knowledge and tools you need to succeed. Chapter 1. Introduction to Hedge Funds. Hedge funds are alternative investment vehicles that have become increasingly popular in recent years. Unlike traditional investment vehicles such as mutual funds or exchange traded funds (ETFs), which are heavily regulated and seek to generate returns by investing in a diversified portfolio of stocks, bonds, and other securities. Hedge funds are typically more flexible and employ a wider range of strategies to generate returns. Some hedge funds employ a long short strategy, which involves taking both long and short positions in various securities in an effort to generate returns regardless of market direction. Others may use leverage or borrowed money to amplify the returns. Still, others may employ more complex strategies such as arbitrage, where they seek to profit from discrepancies in prices of the same security on different markets. While hedge funds have the potential to generate attractive returns, they also come with unique risks and considerations. For one, hedge funds are generally only available to accredited investors or those who meet certain income or net worth thresholds. In addition, hedge funds are not required to disclose their holdings or share performance data with the public, so it can be difficult for investors to get a clear picture of what the fund is actually invested in or how it has performed. Despite these risks, hedge funds have become a popular choice for investors looking to diversify their portfolios and potentially generate higher returns. In the following chapters, we will delve into the different types of hedge funds, their investment strategies, and the risks and considerations involved in investing in them. Chapter 2: The different types of hedge funds. Hedge funds are a diverse set of investment vehicles that employ a wide range of strategies to generate returns. In this chapter, we'll take a closer look at some of the different types of hedge funds that exist and the strategies they use. 1. Equity long short funds. These hedge funds take long and short positions in stocks with the aim of generating alpha, outperformance, by taking advantage of both positive and negative trends in the market. They typically buy undervalued stocks they expect to rise, long positions, and short overvalued stocks they expect to fall. 2. Event driven funds. Event driven hedge funds invest in companies that are experiencing corporate events such as merger, acquisitions, bankruptcies, and restructurings. They aim to take advantage of mispricings and inefficiencies in the market that result from these events. 3. Macro funds. Macro hedge funds focus on broad economic trends and take positions in multiple assets classes, including stocks, bonds, currencies, and commodities. They use top down analysis of economic trends and policies to make their investment decisions. 4. Quantitative funds. These hedge funds use mathematical models and algorithms to identify investment opportunities. They typically rely on large amount of data and advanced statistical techniques to generate returns. 5. Fixed income funds. These hedge funds invest primarily in fixed income securities such as bonds and debt instruments. They may use a variety of strategies such as credit analysis, duration management, and yield curve positioning. 6. Multi-strategy funds. Multi-strategy hedge funds employ a combination of different strategies such as equity, long-short, event-driven, and macro in order to diversify their portfolio and generate returns from multiple sources. 7. Global funds. These hedge funds invest in markets all around the world and may use a variety of strategies to generate returns. They may have a particular focus on emerging markets or other areas of the world where they see opportunities for growth. 8. Sector specific funds. These hedge funds focus on specific sectors such as healthcare, technology, or energy. They aim to identify undervalued stocks within a particular sector and take positions accordingly. 9. Distressed debt funds. These hedge funds invest in distressed debt securities such as bonds and loans of companies that are in financial distress. They aim to generate returns by restructuring the debt and or taking over the company. These are just a few of the many different types of hedge funds that exist. By understanding the different strategies that hedge funds employ, investors can better assess which type of hedge funds may be suitable for their investment goals and risk tolerance. Chapter 3: The benefits of investing in hedge funds. Hedge funds offer several potential benefits that make them an attractive choice for investors. Here are a few key reasons why investors may consider adding hedge funds to their portfolios. 1. Diversification. Hedge funds can offer investors diversification benefits by providing exposure to a wide range of assets, sectors, and investment strategies. By investing in hedge funds, investors can potentially reduce the overall risk in their portfolio. 2. Potential for higher returns. Because hedge funds are able to employ a wide range of investment strategies, they may be able to generate higher returns than traditional investment vehicles. 3. Active management. Many hedge funds managers are highly skilled at identifying and exploiting inefficiencies in the market by actively managing a portfolio. Hedge funds managers may be able to generate returns that outperform the broader market. 4. Risk management. Hedge funds often employ risk management techniques such as using derivatives and taking both long and short positions to mitigate risk and protect against market downturns. This can make them less volatile than traditional investments. 5. Professional management. Hedge funds are typically managed by highly skilled and experienced investment professionals who have access to sophisticated research and analysis tools. This can give investors confidence that their investments are in good hands. The idea behind diversification is that by investing in a diverse range of assets, you can potentially reduce the overall risk in your portfolio. This is because different asset classes and sectors tend to have different levels of risk and return. And by investing in a mix of these assets, you can potentially mitigate the impact of any one asset, class, or sector experiencing a downturn. For example, if you invest solely in stocks, your portfolio could be heavily impacted by a downturn in the stock market. However, if you also invest in bonds, real estate, and other asset classes, the impact of a stock market downturn may be lessened. Hedge funds can help investors diversify their portfolios in several ways. For one, hedge funds often invest in a wide range of assets, including stocks, bonds, currencies, commodities, and derivatives. This can give investors exposure to a diverse range of assets that may not be available through traditional investment vehicles. Additionally, hedge funds often employ a variety of investment strategies such as long short, arbitrage, and others, which can further diversify a portfolio. Active management refers to the practice of actively selecting and trading securities in an effort to outperform a particular benchmark or index, in contrast to passive management, which seeks to track the performance of a benchmark by holding a diversified portfolio of securities in the same proportion as the benchmark. Active management involves actively buying and selling securities in an attempt to generate returns that exceed the benchmark. Many hedge funds employ active management strategies in an effort to generate higher returns for investors. Hedge funds managers may use a variety of techniques to try to outperform the market, such as conducting thorough fundamental analysis of securities, identifying mispriced assets, and exploiting inefficiencies in the market. There are several potential benefits to active management. For one, active managers may be able to identify and capitalize on investment opportunities that passive managers might miss. Additionally, active management may offer the potential for higher returns as managers can take position in undervalued securities and potentially generate significant returns if the securities' values increase. However, active management also comes with its own set of risks. For one, it can be more expensive than passive management, as active managers may charge higher fees for their services. Additionally, active managers may not always outperform the market, and the returns may be more volatile than those of passively managed portfolios. As with any investment, it is important to carefully consider the risks and potential benefits of active management before making a decision. Risk management is an important aspect of hedge fund investing, as hedge funds often employ complex and potentially volatile investment strategies in an effort to generate higher returns. There are several risk management techniques that hedge funds managers may use to help mitigate risk and protect the value of their investors' capital. One common approach is to diversify the hedge fund's portfolio by investing in a wide range of assets, such as stocks, bonds, currencies, and commodities. This can help to spread risk across different sectors and assets classes, reducing the overall volatility of the fund's returns. Hedge fund managers may also use financial instruments such as futures, options, and swaps to hedge against potential losses on certain positions. For example, a hedge fund manager might purchase put options on a stock that they are bearish on, which gives them the right to sell the stock at a predetermined price in the future. This can help to limit potential losses if the stock declines in value. In addition to these techniques, hedge fund managers may also use risk management software and other tools to help identify and monitor potential risk exposure within the funds by regularly reviewing and analyzing the risk profile. Hedge fund managers can make informed decisions about how to allocate capital and manage risk within their portfolios. Hedge funds are investment vehicles that are typically managed by professional investment managers who are responsible for making investment decisions and executing trades on behalf of fund. These managers typically have extensive knowledge and experience in finance, and they may employ a wide range of investment strategies in an effort to generate higher returns for their investors. One key advantage of professional management is that it allows investors to access expertise and resources that may not be available to them on an individual basis. Professional managers have access to a wide range of research and analysis tools, and they often have extensive networks of contacts and resources that they can draw on to make informed investment decisions. In addition to providing access to professional expertise, hedge funds manager may also be able to act more quickly and flexible than individual investors. This can be particularly important in fast-moving markets where the ability to respond quickly to changes in market conditions can be a key factor in achieving good returns. Chapter 4: Long and Short Strategies in Hedge Fund Investing. Long and short strategies are a common tactic used by hedge funds to generate returns in both rising and falling markets. These strategies involve taking both long and short positions in various securities with the goal of profiting from both increases and decreases in price. In this chapter, we will explore the different types of long-short strategies that hedge fund managers may use and discuss the potential benefits and risks of these tactics. Types of long-short strategies. There are several different types of long-short strategies that hedge fund managers may employ, including 1. Market neutral. In a market neutral strategy, the hedge fund manager seeks to profit from the price differential between long and short positions, rather than from the direction of the market. This can be achieved through a variety of techniques such as pair trading, where the fund takes a long position in one security and a short position in similar security, or through the use of options and other derivatives. 2. Directional. A directional long-short strategy involves taking a bullish or bearish view on a particular market or sector. The hedge fund manager may take long position in securities they believe will increase in value and short positions in securities they believe will decline in value. 3. Event driven. An event driven long short strategy involves taking position in securities that are likely to be impacted by a specific event, such as an earnings announcement or a merger or acquisitions. The hedge fund manager may take long positions in securities they believe will benefit from the event and short positions in securities they believe will be negatively impacted. One of the main benefits of long short strategies is that they allow hedge fund managers to potentially profit in both rising and falling markets. This can provide a level of diversification and downside protection that may not be available through other types of investments. In addition, long short strategies can allow hedge fund to take advantage of mispricing and inefficiencies in the market, which can potentially generate higher returns. As with any investment strategy, there are risks associated with long short strategies. One risk is that the hedge fund manager may make incorrect predictions about which securities will increase or decrease in value. In addition, long short strategies can be affected by changes in the market conditions and the overall level of volatility in the market. Finally, there is a risk of margin calls if the fund's leverage is too high and the value of its portfolio declines significantly. Long short strategies can be an effective tactic for hedge fund managers seeking to generate returns in both rising and falling markets. However, it is important for investors to understand the risks and limitations of these strategies and to carefully consider the risk tolerance before investing in a hedge fund that employs long short tactics. Chapter 5. Arbitrage Strategies. Arbitrage is a practice of taking advantage of price discrepancies in different markets or between different assets. Hedge fund may use arbitrage strategies as a way to generate returns without taking on significant market risk. There are several different types of arbitrage strategies that hedge fund managers may employ, including 1. Statistical arbitrage. This involves using statistical techniques and algorithms to identify mispricing in the market and then taking advantage of those discrepancies through the use of long and short positions. 2. Merger arbitrage. In a merger arbitrage strategy, the hedge fund manager takes positions in the security of companies that are involved in a merger or acquisition. The fund may take long position in the acquiring company and short positions in the target company, with the aim of profiting from the price differential between the two. 3. Convertible arbitrage. A convertible arbitrage strategy involves taking position in both the equity and debt of a company. The hedge fund manager may take a long position in the company's equity and a short position in its convertible bonds, with the aim of profiting from the price differential between the two. 4. Fixed income arbitrage. In a fixed income arbitrage strategy, the hedge fund manager takes position in various fixed income securities, such as bonds, with the aim of profiting from discrepancies in the prices of these securities. Arbitrage strategies can offer a number of potential benefits to hedge fund investors. These strategies can potentially generate consistent returns with low level of volatility, as they are not reliant on the overall direction of the market. In addition, arbitrage strategies can provide a level of diversification to a hedge fund portfolio, as they may be less correlated to other types of investments. However, it is important to note that arbitrage strategies may also carry certain risks. For example, the spread between the prices of the securities being arbitraged may narrow or disappear entirely, reducing or eliminating the potential for profit. In addition, changes in the market conditions or regulatory environments can impact the viability of arbitrage strategies. As such, it's important for investors to carefully consider the risks and potential rewards of arbitrage strategies before investing in a hedge fund that employs these tactics. Chapter 6: Leveraging. In the context of hedge fund investing, leverage refers to the use of borrowed money to amplify potential returns on an investment. Hedge funds may use leverage in a number of ways, such as by borrowing to invest in more securities or by using financial derivatives such as options or future contracts. Using leverage can increase the potential returns on an investment, but it can also increase risk. If the value of the investments declines, the hedge funds may be required to sell assets or come up with additional funds to meet its debt obligations. This can amplify losses and lead to margin calls, which require the hedge fund to either add more capital or sell some of its holdings. Hedge funds may use leverage to varying degrees, depending on the investment strategy and risk tolerance of the fund. Some hedge funds may use leverage sparingly, while others may use it more aggressively in an attempt to generate higher returns. It's important for investors in hedge funds to understand the level of leverage that a fund is using and the associated risks. Here are a couple of examples of how leverage can be used in hedge fund investing. 1. Borrowing to invest in more securities. A hedge fund may borrow money and use it to buy additional securities such as stocks, bonds, or other assets. For example, a hedge fund with $10 million in assets may borrow an additional $10 million and use the total $20 million to invest in a diverse portfolio of securities. If the value of the securities increases, the hedge fund may be able to pay off the loan and realize a profit. However, if the value of the securities declines, the hedge fund may be required to sell assets or come up with additional funds to meet its debt obligations, which could amplify losses. 2. Using financial derivatives. A hedge fund may use financial instruments such as options or futures contracts to increase leverage. For example, a hedge fund may buy call options on a stock, which give the fund the right to buy a certain number of shares at a fixed price in the future. If the stock price increases, the hedge fund can exercise the options and buy the shares at the lower fixed price, realizing a profit. However, if the stock price declines, the hedge fund may not exercise the options and may lose the premium paid for them. It's important to note that leverage can increase the potential returns on an investment, but it can also increase risk. Investors in hedge funds should understand the level of leverage that a fund is using and the associated risks. Chapter 7: Growing Trends in Hedge Funds. The hedge fund industry has evolved significantly over the past few decades, and there are several trends that have emerged in recent years. Here are a few key trends in the hedge fund industry. 1. Increased regulation. In the wake of the financial crisis of 2008, there has been increased scrutiny and regulations of the hedge fund industry. This includes the implementation of the Dodd-Frank Act in the United States, which introduced new reporting and disclosure requirements for hedge funds. There has also been a trend towards greater transparency in the hedge fund industry, with many funds now providing more detailed information about their investment strategy and holdings to investors. 2. Growing popularity of alternative investments. Hedge funds and other alternative investments, such as private equity and real estate, have become increasingly popular with investors. This is partly due to the low yields on traditional assets such as bonds, which have made alternative investments more attractive. 3. Rise of quant hedge fund. Quantitative hedge funds, which use algorithms and advanced mathematical models to make investment decisions, have become more popular in recent years. These funds rely on data and computer driven analysis to identify investment opportunities and manage risks. 4. Increased use of technology. Hedge funds have been adopting technology in a number of areas, including trading, risk management, and compliance. Many hedge funds now use high speed trading systems and advanced analytics tools to make investment decisions and manage risks. 5. Growing focus on sustainability and ESG. There has been a growing focus on sustainability and environmental, social, and governance (ESG) issues in the hedge fund industry. Some hedge funds have incorporated ESG criteria into their investment processes, while others have launched specifically to focus on sustainable investing. 6. Evolution of fund structures. Traditional hedge fund structures, such as the use of offshore jurisdiction and the use of limited partnerships, have come under scrutiny in recent years. There has been a trend towards the use of alternative fund structures, such as onshore vehicles and corporate structures, which may offer greater transparency and flexibility. Chapter 8. Starting a hedge fund. Starting a hedge fund can be a complex and time consuming process, but it can also be a rewarding way to manage investments and potentially earn significant returns for investors. Here are some steps to consider when starting a hedge fund. 1. Develop a solid investment strategy. Before starting a hedge fund, it is important to have a clear investment strategy in place. This should include the types of investments that the hedge fund will make, the risk level of the investments, and the target return for investors. 2. Create a business plan. A business plan should outline the goals of the hedge fund, the target market for the fund, and the operations and management of the fund. It should also include financial projections and a marketing plan. 3. Register the hedge fund. In order to legally operate as a hedge fund, you will need to register with the appropriate regulatory bodies. This may include registering with the Securities and Exchange Commission (SEC) and states' securities regulators. 4. Raise capital. Hedge funds typically require a significant amount of capital to start and operate. This may involve reaching out to potential investors such as accredited individuals, institutions, and family offices to raise the necessary funds. 5. Hire a team. Depending on the size of the hedge fund, you may need to hire a team of professionals to assist with operations, including portfolio management, compliance, and administration. 6. Market the hedge fund. Once the fund is up and running, it is important to market the fund to potential investors and to keep current investors informed about the fund's performance. This may involve creating marketing materials, attending industry events, and maintaining a presence of social media. Starting a hedge fund can be a challenging but rewarding endeavor. It is important to carefully plan and prepare in order to increase the chances of success. Structuring your team and investment process is an important part of running a successful hedge fund. Here are some considerations for how to structure your team and investment process for success in hedge fund investing. 1. Assemble a diverse team. A diverse team with a range of skills and expertise can bring different perspectives to the investment process and help to mitigate risk. Consider hiring professionals with backgrounds in finance, economics, and other relevant fields. 2. Establish clear roles and responsibilities. It is important to clearly define roles and responsibilities within the team to ensure that everyone is working towards the same goals and that there is no overlap or confusion. 3. Develop a structured investment process. A structured investment process can help to ensure that investments are thoroughly researched and that decisions are made in a disciplined and consistent manner. This process should include identifying investment opportunities, conducting due diligence, and making and executing investment decisions. 4. Implement risk management strategies. Risk management is an essential part of running a hedge fund. Consider implementing strategies such as diversification, stop loss orders, and stress testing to mitigate risk. 5. Regularly review and assess performance. Regularly reviewing and assessing the performance of both the team and the investment process can help to identify areas for improvement and to ensure that the hedge fund is on track to meet its goals. By structuring your team and investment process effectively, you can increase the chances of success for your hedge fund. It is important to continually reassess and adapt these structures as needed in order to stay ahead of market trends and to achieve long-term success. As an investor or trader, there are several key lessons that can help you to be successful. Here are a few. 1. Develop a solid investment strategy. Having a clear investment strategy can help you to make informed decisions and stay focused on your long-term goals. Consider factors such as your risk tolerance, time horizon, and investment objectives when developing your strategy. 2. Diversify your portfolio. Diversification can help to mitigate risk by spreading your investment across a range of asset classes and sectors. This can help to protect your portfolio against volatility in any one particular area. 3. Stay up to date with market developments. Staying informed about market developments and trends can help you to make informed investment decisions. Consider subscribing to industry newsletter and following financial news sources to stay up to date. 4. Understand the risks associated with investing. It is important to understand that all investment carry some level of risk. Be sure to carefully consider the risks associated with any investment before making a decision. 5. Don't let emotions guide your decisions. It can be tempting to let emotions guide investment decisions, but this can often lead to poor decision making. Instead, try to stay disciplined and stick to your investment strategy. 6. Don't try to time the market. It can be difficult. It is not impossible to accurately predict market movements. Rather than trying to time the market, focus on building a diversified portfolio and holding investments for the long term. By following these key lessons, you can increase your chances of success as an investor or trader. Chapter 9: Hedge Funds and the Economy. Hedge funds have grown significantly in size and importance over the past few decades, and their impact on the broader economy has become increasingly significant. In this chapter, we'll take a closer look at the role that hedge funds play in the economy and the impact they can have on financial markets. The growth of hedge funds. Hedge funds have grown rapidly in recent decades, with assets under management AUM reaching an all-time high of over $3 trillion in 2020. This growth has been driven by a number of factors, including increasing demand from institutional investors such as pension funds and endowments, as well as the development of new investment strategies and financial instruments. Hedge funds and financial markets. Hedge funds can have a significant impact on financial markets due to their large size and active trading strategies. For example, hedge funds may engage in short selling or take large position in certain stocks, which can affect stock prices and the overall performance of the stock market. The role of hedge funds in the 2008 financial crisis. Hedge funds played a role in the 2008 financial crisis, which was caused in part by a housing market bubble fueled by subprime mortgage lending. Hedge funds were heavily invested in the mortgage-backed securities that were at the center of the crisis, and when the housing market collapsed, many hedge funds suffered significant losses. The failure of several hedge funds, including Bear Stearns' two hedge funds, also contributed to the broader financial crisis. These failures sparked a wave of panic selling in the financial markets, exacerbating the crisis and leading to a number of bank failures and government bailouts. Regulation of hedge funds. The role that hedge funds played in the 2008 financial crisis has led to increased scrutiny and regulations of the industry. In the United States, hedge funds with over $100 million in AUM are required to register with the Securities and Exchange Commission (SEC) and provide regular disclosures on their investment strategies and performance. The Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 also included provisions that gave regulators increased oversight of the hedge fund industry. These regulations have included requirements from hedge funds to maintain certain levels of liquidity, restrictions on their use of leverage, and increased reporting and disclosure requirements. Conclusion. Hedge funds have become an important part of the financial landscape, and their impact on the broader economy and financial markets is significant. While the industry has faced increased regulation in the wake of the 2008 financial crisis, the growth of hedge funds is likely to continue in the years to come. It's important for investors to understand the risks and potential impact of hedge funds on the broader economy when making investment decisions.